All right, let's see. Is Jackson Woods here? How about Caitlin? Bartol? Yep. Andrew? Esperanza? Brandon Taylor? Yolan? Here. Okay. Lewis? Wilson? Gilmore? Yep. Ben? John? John?
Hello.
Hello? Logan? Nicholas? Matthew? Ashley Middleton?
Here.
Okay. Ian? Angelo? Klein? Yep. Carl? All right, is there anyone that in physically here that I did not call? What's your name, young man?
John Kesterson.
Jefferson?
Kesterson.
Okay. And anyone else? I think I got everyone else. Supposed to be here on Mondays. Okay. All right. Okay. So we're ready to start. So just a couple of announcements. Get us started. Let me go over to Connect for just a moment. Under week 2, well, let's back up. Week 1, you should be finishing your assignments tonight by midnight. So make sure you get that chapter 1 knocked out by midnight. For this week, we're going to be covering chapter 2. So in your Connect, you'll have the reading, the Learn Smart, which is graded, the interactive, which is graded. So those 2 are graded. You'll have chapter 2 problems that come from your chapter. You also have practice exercises, which are just like the problems from your textbook that you're going to work for a grade, but they're just for practice. So you can work those any and all you want to do. You can work them as many times as you want to do in order to prepare for the graded assignments. But the practice problems are not graded in any way, right? So that's just for your benefit. Then you have your chapter 2 quiz, and you will have your first exam on chapters 1 and 2. All of this will be due a week from today. So that's February the 8th. So you will actually be taking this exam on Connect. So it will not be a timed exam, and it will be one attempt with one check my work, right? Just like your quiz. And I'll talk more about that on Wednesday, the actual format. Everything is due by next Monday. Any questions on that? Okay. Do keep in mind that you have the PowerPoints located on your Connect. If you want the PowerPoints, go all the way down to the left-hand side, click on Files, and they're listed here. So there's chapter 2, if you would like those. Anyone ran into any problems with Connect? Okay, if you have, please let me know and we will resolve those. All right, any questions before we get started on our material? Quite good. All right, can you guys on Zoom verify that you're seeing the PowerPoint that says chapter 2?
Indeed.
Yeah, I can see it.
Yeah.
All right, so let's go ahead and get started with this week. So just to review a little bit from last week, we went through quite a bit of terminology, and we talked about assets, liabilities, stockholders' equity, And what is the accounting equation that we utilize? What is the accounting equation? Anyone?
Assets equal liabilities plus stockholders' equity.
Correct. Okay, assets equal liabilities plus stockholders' equity, or assets minus liabilities equal stockholders' equity. We state that either way. What are the two things that increase equity? Two things that increase equity. Very important.
Issue stock and retain earnings.
Issue stock and net income or profit. Right? What are the two items that decrease equity?
Net loss.
Dividends and net loss. Okay, so dividends, if you pay dividends, and if you incur a net loss. So you guys want to remember those things. It's important because as we go through the course, we'll look at various types of transactions that we have in the business. And if those transactions aren't one of those four, then they're not going to affect the overall value of the company. And we'll see that as we start into this chapter. What are the four basic financial statements? Income,
Statement of cash flow.
statement of cash flow, balance sheet, statement of retained earnings. Now, sometimes you'll hear the statement of retained earnings called the statement of equity, and that's fine. It's the same thing, right? So it just depends on the company that's preparing it. Remember, kind of as an FYI, on your headers for your financial statements, which of the four statements is prepared as of a specific date? Balance sheet. The others are for a period of time. So remember that, because I'm sure it will show up somewhere on a test, right? So balance sheet at a particular point in time. All right, so this week we're going to focus on the balance sheet. So what type of accounts go on a balance sheet? Assets, liabilities, and equity. So those are what we're going to focus on this week. So when we talk about these accounts, we've already defined what they were. We talked about asset and what they were in terms of something we own that has value and that is measurable. We got to remember we can measure it in some way. If you are a company and you have really good employees that work for you, they're well trained, they do a good job, are those recorded as assets? What do you think? Angela? Is that right? Or Ashley?
Ashley.
Ashley, okay. What do you think, Ashley?
What did you say again?
If you have employees that work in your company that are very valuable to you, meaning they're good employees, do you record those as assets?
No,
No. Why not?
because assets are something you own.
You own. So there we go. Okay. Those people leave work every day. You don't own them. So we refer to those as economic assets. That's not what we're talking about here. There are certain components of a business that have value, but we cannot record them as an asset because they don't fall into that category. Things like employees, reputation, location, competitors, so on and so on, market share. Those things aren't quantifiable because remember, to record something, we have to be able to quantify it. And those items aren't. Okay. Now we will look at one situation later on where when another corporation buys out another company, for example, many times the corporation that's making the purchase will pay more than what that company is worth. So what do we do with that additional amount? So if the balance sheet says the company's worth $1 million and the buyer pays $1.2 million, we got a $200,000 difference there. We'll talk about that a little bit later in the course. Liabilities, we said, are items that we owe to our creditors, various types of creditors, and we've already talked about stockholders' equity. So we should be clear on that definition. So remember, we talked about companies can finance one of two ways. And financing means they are raising assets of various types. They can either do it through debt, by borrowing, or they can do it through equity, by issuing stock. What are the advantages of borrowing as opposed to equity? Give me some advantages of borrowing. I can't think of a lot.
You get the cash when you need it.
Okay, get the cash when you need it. Okay. You can usually structure the terms of your borrowing. So you could say, here's the way we're going to pay it back over a period of time. What are some of the disadvantages of debt financing? Pardon me?
Would it be considered like a limit?
Yeah, you're going to have a set amount initially that you're going to be borrowing. Plus, in the future, you have to what? Pay it back with interest. Okay. So that, of course, is the disadvantage in terms of debt. The other disadvantage might be when you borrow, you're limited to a certain amount. So if you want to acquire more funds, then you would have to go back to the lender and reapply for additional funds. Right? Now, equity finance. What is the advantage of equity finance? What is equity finance? Selling your what?
Your company?
Your stock, right? So selling your stock. So what's the advantage of that from a financing standpoint? What is it costing you if you issue stock?
Ownership of the company.
Yeah, ownership of the company per se, but you remember, you don't own it anyway. Unless if you already have stockholders and you're adding additional stock. Okay, but it does create what we call dilution of ownership. So if the stockholder owns 10% now of the stock and we turn around and reissue more stock, in total, that stockholder is going to own less than 10% because there's more stock being sold. Okay? So when we have debt financing, we know what we're going to get. We know how much we're borrowing. Agreed? What about equity? When we issue stock, what do we get? How much would we get? Can we quantify that to project? What drives the price of the stock, Andrew?
Performance, earnings, revenue.
Okay, all of that influences what drives the price. What ultimately determines the price of the stock? Ultimately,
Volume.
the buyer and the seller. Okay, who wants to buy? Who wants to sell? And all of those things you mentioned will influence that decision. But we have to think about the point where those two items meet, and of course, that's the sale price of the stock. So when a company issues stock, it's going to receive whatever price that stock trades for initially on the stock market. Now, they're going to estimate what that stock is worth, but so they might issue the stock initially. They might say, okay, we're going to set a starting price of $10. So what's it called when the stock is first issued? When a corporation issues its first stock, what is that called?
IPO.
IPO, initial public offering. So when we have the IPO is going to say, this stock is going to go on this market on this day at an opening price up. So at that point, the stock starts trading. And if the market believes the stock is undervalued, the price will go up. If it believes it's overvalued, the price will go down. We call that the primary market. You want to remember that. Primary market is when the stock is initially issued, because the corporation is going to get the money from the stock that's originally issued. Of course, minus there'll be a few expenses they have, but if they issue $1 million worth of stock on the IPO, they're going to get $1 million. And they have a few expenses in there, so they'll get roughly 900-something. That is the primary market. Now, let's say all of you guys buy stock in that company. If you sell that stock, how much additional money will the corporation get?
None of it.
None of it. Because that transaction is between you, the seller, and the other person that buys it. We call that the secondary market. So when stockholders buy and sell, that's between them. So that has absolutely no effect on the corporation financially. Now, obviously, the corporation wants to keep the stock price high because they want to make their stock attractive for the investors so that the investors will continue to buy and hold on to the stock as opposed to the opposite happening. But as far as the actual cash flow, there is none. So if the corporation wanted to generate additional cash, they would have to issue more stock. In other words, they'd have to put more stock on the primary market. So that is what we refer to as equity financing. Can a corporation buy back its stock off the market? Andrew says yes. He's correct. Sometimes corporations buy back their own stock. And we'll talk about that later on when we get into the chapter on more detail. So remember, debt financing costs you interest. So with debt financing, the person that's lending the money is guaranteed, per se, to get that money back. What about a stockholder? What is the stockholder required to get back? Nick, nothing. So the corporation that's issuing that stock has no liability there. Stock is risk, so you make that choice when you buy the stock. So that's certainly another advantage of stock for the corporation. All right. All right, so here are a few things to remember in regards to this process. A company always documents its activities. We've already talked about that. Whenever we have a transaction that affects the financial position that is quantifiable, meaning we can put a number with it, we're going to record it in the accounting record. A company always receives something and gives something. So when you have a transaction, the company is either giving something or receiving something. So if they're giving something, the other party in the transaction is what? Receiving. And if they're receiving, the other party is giving. But we're not going to worry about the other party. So we're going to worry about our corporation. But just keep in mind, there's always a second party involved in that transaction as we have each event. A dollar amount is determined. Of course, we have to be able, as I said, to quantify the transaction. If there's no dollar amount, then we can't quantify the transaction. Well, let's say, though, for example, that Ian owns a company, and he owns let's go with the lawn maintenance company. And I'm an accountant. And Ian says, I tell you what, Jay, if you'll do my books for me, keep up with my books, I'll mow your yard for free each month. Okay? Is that a recordable transaction? What do you think? Will Ian need to record that transaction? What do you think? And will I need to record it? The answer is yes. But you might say, well, there's no cash involved. We're just swapping services. Well, that's okay, because he's giving me something of value, and I'm giving him something of value. So if he were the one providing me the lawn services, he would record revenue for whatever amount he charges, because he's providing the service. I would record revenue for the amount I would charge for doing his books, where I would be paid in cash. Okay? We call that bartering. Heard the term bartering? Bartering is where you exchange things other than cash. You do this for me, I'll do that for you. Or you give me this and I'll give you that. Regardless of whether we get cash or not, we have to value those items. And we have to record them in the accounting records based on their fair value. So to get fair value, I said Ian would record it for whatever he charges, and that is the fair value or the market value. Same thing on my end. So that would have to be recorded as a transaction. So here we don't even have a dollar amount per se, but we have a value. So that sometimes exists in a business. All right, with transactions, we have external transactions or external exchanges, and we have internal events. External means the transaction involves someone outside the organization. So if Ian mows my grass, that is an external transaction because it's outside of his company. He's dealing with me, and I'm not part of his company. What if he is paying his employees? So what if Andrew works for Ian and he pays his salary? Is that an external or an internal?
Internal.
Internal, because both of those parties are within the organization. So we have transactions that fit one of these two areas, and we'll look at both, right? All right. Now,
Could you go back for a second, please?
sure. There. Sometimes students ask me, which do you have more, external or internal? Just depends. It depends on the size of your company. It depends on what type of product you're selling. It depends on what type of expenses you have, so on and so on. But irregardless, you'll have both. Are we good, guys?
Yes.
All right. So let's talk about the process of getting this information into our accounting records. So there are 3 steps that we go through to start out this process. First thing we do is we analyze. And analyzing simply means, yeah, we got a transaction. And what's going on with this transaction? What's happening? So I'm buying supplies, or I'm paying my salaries, or I'm borrowing money. So we're asking ourselves that to start out with. The second step is the recording process. So we have to record it in some document so that we have a record of that transaction. And we'll look at that process in this chapter. So from there, after we recorded transactions, we can summarize those transactions in the form of a financial statement. So the analysis and recording of transactions happens over a period of time. So maybe February. Throughout the whole month of February, we're going to incur transactions and we're going to be recording them in our accounting records. Then at some point, someone might say, well, how much profit did you make? Well, we need to summarize those into one document so we can present it to readers. And that's the 4 statements we talked about. Now, we call this whole process, and this is just the beginning, we call this the accounting cycle. This is the accounting cycle. Or cycle, if you look in the upper right-hand corner of this slide, you see a cycle. So this process recurs over and over and over that we're learning. So it's very important that we understand this process and where everything fits in to that process. All right. A transaction has at least 2 effects on the accounting equation. Okay. It's going to have at least 2 effects. And we'll look at some examples of this. Okay. You cannot record a transaction with just one effect. If you did, your equation would be out of balance. So you have to think when we're doing these, what are 2 or more things that are being affected in this transaction? Right? And we've already said that when we analyze the transaction, it's going to affect the accounting equation. So that when we finish, that equation will remain in balance. All right. Step 1, analyzing the transaction. All right, so we read a transaction and we say, oh, I've got to record this. The first thing we do is we go to our chart of accounts. What is a chart of accounts? It's just a list of all the different types of expenses or assets or liabilities that you have within your company. So we create an account for each type of transaction. So cash is an account. Accounts payable is an account. Salaries expense is an account. Utilities expense is an account. Retained earnings is an account. So on and so on. So all of these account names that we create is called your chart of accounts. Now, there is no requirement that the chart of account must include this and this. The chart of accounts is created by the company for whatever it needs. Okay? So they have their own transactions, so they might look at this transaction and say, well, I've got this event happening, but I don't have an account for that. So all they do is set it up. They create it. All right? So this is called our chart of accounts. And here's an example of a chart of accounts. They start out with cash. They have a supplies account, equipment account, so on and so on. Each account is assigned an account number. And this will serve a purpose later on. Yeah.
They always the same with cash, always 100.
Yep, you can create your own method. Now, it's common practice, though, for all accounts to begin with a 1. but it's not required, Andrew. I mean, you can do whatever you want to do. Okay? It's just common practice. But you'll notice here that we group the accounts by type. So look at these first 1, 2, 3, 4, 5. What type of accounts are those? They're assets, right? So assets are starting with a 1. Then we have accounts payable and notes payable. Those are what type of accounts? Liabilities. So we're starting them with a 2. Then we have our stockholders' equity. We have common stock and retained earnings, and we're starting those with a 3. So regardless of whatever method you're using to number, it's a good idea to sequence them with starting numbers that are different so you can easily find them and you can easily identify what type of an account they are, right? But again, you can go crazy if you want to create your own chart of accounts and your own account numbers. It's fine and dandy because nobody's going to see this except you. Those numbers don't go outside the company. So you create what you want to create. Just remember, the more complex you make it, the harder it's going to be to manage. Okay? So I always use the old KISS principle. You guys know what that is? KISS, keep it simple, stupid. Okay? When you don't have to make it complex, don't make it complex. Okay? Keep it simple because then you're just creating more work for yourself. Right? So that's an example of a chart of accounts, and we're going to be using Noodle Cake. This is our fictitious company that we're going to be using here. So that's the chart of accounts. All right, now let's look at some transactions that they have. So they're going to start out on August 1st. It says the company issues stock to Jordan and Ty as evidence of their contribution of $10,000 cash, which is deposited in the company's bank account. So the company sells stock to Jordan and Ty for $10,000. One gives, one receives. Noodle receives. The two guys, or Noodle gets cash, the two guys get cash. Okay? Now, first thing we do is we analyze what I just did. So when we analyze, after we figure out what's going on, we go back to our chart of accounts and say, hey, which of these accounts are going to be affected here? And I got to pick out at least two. Got to pick out at least 2. Remember, we said at least 2 things have to be affected. Can be more than 2, but it's got to be at least 2. So we talked about this transaction and we picked out cash and common stock. And we know what we're going to use here for our transaction. Now let's look and say, okay, how's this going to affect the accounting equation? So we're receiving cash. So cash is in asset, and the cash is going up. So we put that as a plus 10,000. What are we giving? We're giving stock. Stock is part of equity. So if we're issuing stock, remember, what does that do to equity? Up. So we have plus 10,000 on the left side of the equal sign, and we have plus 10,000 on the right side of the equal sign. So we say that that transaction is in balance. It is a balanced transaction. Okay. Next one. Noodle Cake pays $300 cash to create the company's logo. What accounts are affected?
Logo and trademark.
No. Logo, yeah, logo and trademark is one of them, right? Need one more though.
201 accounts payable.
No. What are you giving?
Cash.
Cash. What's accounts payable? Something you owe that you're going to pay later. Okay? So here we're paying cash for the trademark. Right? So we have two accounts. We have logo, trademark, and we have cash. Now, it just so happens in this transaction, they're both assets. Cash and logo trademark. That's fine. In fact, we have transactions like that all the time. But your logo trademark, since you're acquiring a logo, is going to increase. So you'll put that in as a plus. Your cash is going down. So you'll put that in as a minus. So what is that net to? What is the net of plus 300 and minus 300?
0.
How about 0? So if we got 0 on this side, don't have to worry about that side. Okay? So if the transaction is completely on one side or the other, it would net to 0. Right? Now, if that was not the case here, we'd have to enter something over there. Okay? We also call this an asset exchange transaction. Simply swapping one asset for another. All right, number C, or letter C. Noodle Cake borrows $20,000 from a bank, deposits those funds in its bank account, and signs a formal agreement to repay the loan in 2 years. What do you think? Notes payable and what they get? Cash. You got cash and notes payable. And you'll notice here it's a long-term notes payable because it's not due for 2 years. Now, if we had a short-term note payable, that would mean it was due within a year or less. Here it's a long-term. And you can have a separate account for short-term notes and long-term. Okay. All right. So let's analyze now. So if they receive cash, cash goes up. Then we have a plus 20,000 under assets. And since they're borrowing, they now owe more than they did, right? So their liabilities are going up. So our transaction now balances. Plus cash and plus liability. Right? Noodle Cake purchases and receives $9,600 in computers, printers, and desks in exchange for its promise to pay $9,600 at the end of the month. So what do you think?
Accounts payable and what was the other one? Equipment.
Equipment. And since they're not paying right now, it's going to be an accounts payable. Right? So, is the equipment value going up or down?
Up.
Up, because we're getting equipment. Are the liabilities going up or down?
Up.
Up, because we take on more debt. So we would record this like this. So equipment goes up, accounts payable goes up, plus 9,600 on both sides. So we're good. Now, in the next transaction, Noodle Cake pays $5,000 to the equipment supplier from this transaction. So we bought this equipment for $9,600, and now we're going to pay $5,000 of that. So what accounts are affected? Cash and accounts payable. Right? It's Cash going up or down? Down. Are accounts payable going up or down?
Down.
Down, because you owe less. So we would record it as such. Cash, negative 5,000. Accounts payable, negative 5,000. Right? Now, Noodle Cake signs a contract with a programmer for program code for the Tiny Warriors game app for $9,000. No code has been received yet. So they just agreed to provide this service to a customer. And they agreed on a price of $9,000. What do we need to do? Nothing. Why? It's just a contract.
Haven't got it yet?
Yep, haven't got it yet. Nothing's exchanged hands. All we have made is an agreement here. Now, at the point that we provide the software code or whatever it may be, then we would record the transaction. But keep in mind, nothing's happened here yet. It hasn't met the criteria for a transaction. Now, Noodle Cake receives the $9,000 of game code ordered, and it pays $4,000 of that in cash, and promises to pay the remaining $5,000 next month. What accounts are affected? Go way back here. So they got the software. They paid $4,000 of it in cash. And they're going to pay the remaining $5,000 later. Software, cash, and accounts payable. Oh, we got 3 accounts. Software, cash, and accounts payable. Is software going up or down? Up. Is cash going up or down? Down. Is accounts payable going up or down? Up, because we owe more, right? So the effect of that transaction then would look like that. Software going up, cash going down, accounts payable going up. Net those two together, we come up with 5,000 under assets and 5,000 under payables. So here we have 3 accounts. That's perfectly fine. Not a problem. Noodle Cake received supplies costing $600 on account. What do you think? You guys are going to have to remember that chart of accounts. I'm not going way back there again. Supplies and accounts too. Supplies are going up or down? Up. Cash is going? No. Cash is unaffected, right? Accounts payable is going up, right? So supplies go up by 600, accounts payable go up by 600. Okay. When you hear the buzzwords on account, you know that there's no cash in that amount. When you hear the word paid, that's pretty much a given. So learn your buzzwords as you read through these transactions. All right, now, here we have a summary, and I'll try to see if I can do anything to zoom on that. I'm not. Okay. I'll go left. Okay. All right, so here is a list then of every one of those transactions we just talked through. So this shows each transaction and where it was recorded in the accounting equation. So when we look at these in this format of Excel, by the way, if we net those transactions together, at the bottom, we come up with the balance in the account. So if we add up all the cash transactions, 1, 2, 3, 4, 5, we come up with an ending balance of cash of $20,700. Supplies only has one entry, so it's 600. Equipment has 9,600. Software, 9,600. Logo trademarks, 300. Payables, 10,2. Notes payable, 20,000. And common stock, 10,000. All we're doing is balancing here. And if you're using Excel, you can just set up a sum function for your columns in Excel, and it'll take care of that. How many of you had Excel class? I'm going to tell you right now, if you have not had an Excel class, I strongly recommend that you get one if you can work it into your schedule here. Because employers today really value individuals that know Excel. Because almost all accounting systems and reporting systems now dump or download files into Excel. So if you're an accountant, you can download transactions into Excel and create your statements. If you're in finance, you can download those transactions into Excel and create analysis of various type of things. If you're in marketing, you can download those transactions and create visuals, so on and so on. So knowledge and the ability to use Excel is one of the top 5 most frequent skills that employers today want. They want you to be able to utilize that software fluently. So with that said, if you can get a class in that, get one. All right, so here we have all of our accounts listed. Not moving. All right, so from there, we have moved from the actual recording process, okay, into the summarize. So what we did here is we did a summary of those transactions, simply meaning we just showed the accounts and their balance. And we can do that at any point in time we want to do that. So we could create, we could, after the first 4 transactions, we could add all this up and create the balance. We can create this anytime we want. Now, if you calculate this, if you add all those balances for assets together, they should equal the other balances on the right-hand side. If they don't equal, you are out of balance. They should equal in the amounts. Even the balances should equal because you've entered everything using the accounting equipment. So that's a good way to check your totals and make sure the left side is equal to the right. Okay. All right. Now we're ready to get into what we call journal entries and key accounts. So here's our transactions we did. And we had 1, 2, 3, 4, 5, 6, 7, 8, 9 accounts. And we had 8 transactions. Well, what if you had 900 accounts? That means you would have 900 columns. And you had 9,000 transactions. Think that'd be a little hard to follow along with? Most likely. So if you were trying to do reports and you were trying to scroll along 900 columns or 9,000 lines, That would be a little cumbersome. You could do it, but it would be a nightmare. So in accounting, we utilize a process called journaling or journalizing. Journalizing is a way that we record the transaction in a concise format. Same transactions that we've done, but we're going to record them in a very concise format. Now, I want to share something with you guys. Hopefully it will be helpful to you. I'm going to draw it here. So, what are you doing? Up there, up there. All right. Here's what I want you guys to write down. I want you to write down
We can't see your screen.
a big old T. This is what we refer to as a T account. An account. T.
Excuse me.
Now, down the middle of this T account, I want you to write the letter A,
Excuse me.
L,
Hello?
I, C, E. What do you think A stands for?
Excuse me, we can't see the screen.
Assets. And what do you think the L stands for? Liability. The I stands for income, which is the same thing as revenue. The C stands for capital. If you remember back last week, we said that's the same thing as stockholders' equity. And then the E stands for expenses. So these are your 5 types of accounts. So in your chart of accounts that you have, every one of those accounts is going to be one of these 5 types: assets, liabilities, income or revenue, capital or stockholders' equity, and expenses. So we have Alice. Right? Now, at the top of this T account, let's write debit on the left side. And we're going to abbreviate that DR. And on the right side, we're going to write credit. And we'll abbreviate that CL. Now, if you get a test question that says, what is a debit? How would you answer that question? What is a debit?
Excuse me. We can't see your screen.
Where's Esperanza? What do you think? What is a debit? Could be, not necessarily. You're making it a little too complex here. It's a very simple definition. A debit is the left side of a T account. That's it. It's the left side of a T account. That's the definition of a debit. What is a credit?
Right side of the T.
There you go. Not too often difficult. So a debit is the left side of the T account, and credit is the right side of it.
Are you able to hear us?
So in accounting, we have debits and credits that we use.
I don't
in
think it's on
recording
Zoom anymore. I don't think you can hear us.
So now we know what those 2 terms are. Now, on your chart,
Penis. Nah,
asset
you can't hear us.
debit
I
column
forget after that.
plus sign. And then go down to the last row, which is expenses, and put a plus sign. right? In between that, put a minus sign. Minus, minus, minus.
Well, can you see us? Come on.
Right? On the other side, the
Oh,
credit
oh,
side, you
over
put the
here.
opposite of what's on the debit side. So we have minus, plus, 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 minus.
Sir, we can't see your screen.
These are the rules of debits and credits. If you can remember this little chart, you can remember the rules.
Can't you hear us in the background though? If he does not
That's
he's
simple.
not seen us, come on.
Doesn't require you
Nah,
to
bro, I
go
already
through
did the
page
penis
after
test. You
page
can't hear
like
us.
book.
Yeah,
If
you're
you
right.
can remember this, you can. Dexter wants my screen. Can't do that, Dexter. Okay. So that is the accounting debits and credits. Now, what does that mean? So you guys, the easy way to remember this is the first one and the last one increase as debits. You can remember those two accounts. Everything else fills in. Because everything in between is minus. And then on the other side, it's the opposite. So it's very easy to remember. So what does this mean? This means that when you have an asset account and the asset balance is increasing, you record it as a debit. Okay? When the balance of the asset account is decreasing, you record it as a credit. Liabilities are the opposite. When the balance of a liability account is increasing, we record it as a credit. Decreasing, we record it as a debit. And so on. It's what we just did a minute ago, right? We picked out the accounts and we said, okay, they're either assets, liabilities, or equity. And then we figured out if they were increasing or decreasing. Now, whenever we're recording debits and credits, there's one thing we have to keep in mind. The total debit amount must equal the total credit amount. So if you have $5,000 in debits, you must have $5,000 in credits when you record the transaction. Just like we did with the accounting report. We said we got to have 5,000 over here, got to have 5,000 over here. So there's no difference in that concept. Right? This is how we record transactions. So as we go forward in the class and we start looking at transactions, analyzing them, we'll also carry forward and utilize this process. So let's just do one of these items.
We couldn't see your screen the whole time.
Couldn't see the, oh, let me go back.
Yeah, we were trying to get your
Solid.
attention, but you couldn't see us or hear us.
Just a suggestion. Next time that happens, tell me real quick.
You
Or
couldn't
you
hear
couldn't hear us.
You couldn't hear us no matter what we could do. We did everything.
I don't know if we'll be able to see the comment.
We'll switch it to the web. Let's see if we can do that. Document. Can we see PowerPoint okay?
Indeed.
Yes.
Thank you. All right, so the reason I put this up here, this is a slide in your PowerPoint and in your book. I would recommend that you ignore it because what I just told you earlier on the chart that I'll provide everyone a copy of is the same thing as this, but it's just in a lot easier format. Okay? So you can follow this if you want, but it's not necessary. It's the same thing that I give you in the T account, right? All right, so what I would encourage you to do then between now and Wednesday, of course, finish your homework that's due tonight. Then read through chapter 2 and make sure you get these concepts down so that you understand them. And then on Wednesday, we'll work through some of these transactions utilizing debits and credits, right? And going forward, we will utilize debits and credits. So with that said, you need to make sure that you understand how to record these using debits credits, right? This is a critical part of learning as we go forward. All right, are there any questions that I can answer? All right.
So that chart you were going over, you're gonna give us a copy of it,
Yes, sir. I will provide
please?
that to you so that you have it. And then you guys, if you have questions on it that you didn't, that once you look at it, let me know and I will address them with you. Okay? All right. Have a great afternoon and I'll see you on Wednesday.
Thank you.
Thank you.
Thank you.
Thank you.